Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
I'm all fired up. We got Brian Regan joining us for this episode. Jeff Perry and I here as well. We are all of the AMR team with Wealth Enhancement. And Brian, just a little team there. Love having you on to talk about all that's going on in the world.
I think I'm about another pot of coffee away from having that kind of
enthusiasm
today. Yeah,
right. We need to get you.
There's not as much to be fired up about today, too. You know.
We'll see.
Yeah, let's see. So we had our recent quarterly webinar for our clientele, and we put up the version of that is for the public. And if you'd like to check it out, you can always get that talk. How long was this one? 45 minutes, a little bit longer, maybe.
I try to do 40 to 45 minutes before questions, and then we have 10, 15 minutes of questions. So
if you want to listen to the guts of it, you can get the real quality involvement in this. Very deliberate, very thorough. There's some charts, some good visual aids in the process. And Brian does a great job elaborating on what are we thinking about? What are we paying attention to? And what are the issues facing investors in the near term? A little bit of how it's affected our, recent experience. But more importantly, what are we looking at as we look ahead? And how is that affecting some of the decisions we're making within our discretionary managed portfolios? So we're going to talk about that a little bit today, but I'm teasing that because I want you to know, if you really want to get a little more in depth, you can get the full version just by going to our webpage. wealthenhancement.com/AMR, I think. Is that the right?
Chris, I'll also put a direct link in the show notes.
Perfect.
So people can go right down after the description of the show, and there'll be a link to the webinar.
Easy way to do it is somethingmorewithchrisboyd.com. You can find us that way. And as you know, but worth reminding in case anyone's not familiar, not only can you find us where you like to listen to your podcasts, Spotify, Apple, Amazon, Google,
you name it.
So you name it, wherever you like to listen to your podcasts. You can also find us on YouTube, or just simply go to our webpage and we post the videos there as well. So we try to make this readily accessible and available to you, and hope you're enjoying it in whichever medium you prefer.
Right. So we're much better looking on audio.
Yeah. face for radio, right? Yeah. Excuse me. So Brian, we had this talk. There's so much to consider with all that's going on in the world, as we were kind of teasing. Oh, before I go on, I want to give a shout out. I had an occasion to, my mom is 89 and change. She had a gathering of her camp friends.
You tell me about this.
She was a child.
That's awesome.
All these ladies came to the Cape. And it was a range of ladies who were, my mom was on the older end, I gather, but I don't want to suggest everybody was the same age if they're listening. But in any case, my aunt was there as well. They all had this experience in camp that was so formative. And one of the ladies mentioned she listens to the podcast. So I figured I'd give a little shout out to the Camp Fernwood crowd there. So in any case, very nice that they had that get together. Let's jump into talking about what's going on in the world. We've got so much focus on artificial intelligence, Brian. Maybe that's a good place to start. Or maybe we should talk about the bifurcated experience of the economy. On the one hand, the market's going like gangbusters. On the other hand, there are some signs of slowing. with jobs and some debt experience. Where do you want to start?
Yeah, so the reason why we do this quarterly is we really want to communicate with our clients and have them understand on a more foundational level why each ticker is in their portfolio. It's not by accident. We have reasons to do it, and this is an effort to explain that to them. Now, after we did this, I got some feedback from clients, and some clients thought I was very optimistic, and some clients thought I was pessimistic on the outlook, which
Isn't that funny?
kind of gets to Chris's point here, where you know, I there are two sides of this economy. You know, I started it by talking about how the consensus expectations for a recession over the next 12 months is at 33%, which is high. But at the same time, the stock market's done very well. So you gotta kind of square that circle, right? And if you were to think about this from a statistical framework, you know, the distribution of possible outcomes have very fat tails, which means, you know, if the economy gets much more productive and earnings on these very large companies that dominate the index continue to do extremely well as they have over the last few years, then I think there's a fantastic chance for fantastic returns. You know, well, there's a fair chance for fantastic returns. I spoke there. At the same time, if we have a recession, which, you know, there's a 33% chance according to the consensus of investors, you know, things won't necessarily be as good. So I kind of understand this, you know, confusion about where I am, right? But I don't think about things in a linear manner. I tend to avoid the question of what I think the stock market's going to do over the next 3-6 months. You know, pick your time frame. What I say is it goes up 80% of the time, and I have an idea of where I think my median expectation would be in the range of distributions. But the range of distribution is very, very wide. The possibility is very wide, and I just want to I want to be invested more aggressively when I think the probabilities of a good outcome are better than fair, and I want to be, you know, underweight risk when I think that's the other way around. And right now, I think the probabilities of a good outcome are good. You know, it's a reasonable expectation. But I also acknowledge that the risks or the possible upside is great, but the possible downside is also great. So we have
elaborate what
weird
you
bell
mentioned
curves.
in that K-shaped analogy you talked about when you started talking about when it came to the challenges. What are those challenges? We all see the market doing phenomenally, but what are some of the things that you worry about that could be problematic in this sort of varied experience of the wage class and the wealth class, you know, having very different experiences of this economy?
Yeah, I mean, the way I framed it is I think we have two parts of the economy going on. We have on the positive side, we have the artificial intelligence economy, which the hyperscalers are putting in nearly $400 billion in 2026 in capital expenditures. That expenditure has a wide range of tentacles that it can hit. You know, to build a data center, you don't not only need the servers, but you need the cooling, you need the foundation that goes into the data centers. You need somebody to provide maintenance on that data centers, and then it has downstream effects, right? You need cybersecurity for that cloud infrastructure. You know, that cloud infrastructure is going to facilitate, you know, robotics, autonomous vehicles, things of that nature. So you can understand how that it's not just the data centers, it's not just the semiconductors, but it's the productive economy that it's driving. You know, from LLMs to you know, autonomous capabilities that we're seeing. You know, from Tesla, from Waymo, from you know, there's military applications. So, you know, the optimism here seems well founded to me. I mean, there's a lot of money going into it. It's being funded from companies that can afford it. It's not like 1999 where people are IPOing without revenue. I mean, there is some of that. You know, Oklo's a good example. It's just got a prototype. It has no revenue to speak of whatsoever, but it's trading, you know, through the moon. So there's a little bit of that in that economy, but you know, reasonably, it seems like people are investing in a bright future. There's a good chance that that could falter. You know, the biggest linchpin in that whole economy is OpenAI. OpenAI has made a lot of promises to be a customer for, you know, basically every large company in the ecosystem. They've made about $1 trillion in promises that over the next 5 years. I don't need to elaborate on how big that number is, right? That's a big promise. But if I think that the capital markets have the animal spirits and the risk tolerance that it currently has, I think they're going to be able to come through on those obligations. Now, that's a big if, right? Like, a lot can change over the next 5 years, and I think that's ultimately what people are concerned about when it comes to the artificial economy. But I think that's something to monitor. And so far, the demand for this economy is basically insatiable, and that's something to monitor. But you know, right now things are good. You know, make hay when the sun's shining is kind of my thought process there. It will rain someday, but worrying about that today seems early. The other side of that K shape, right? We have one part of the K going up, one part of the K going down. Are the effects of tariffs, student loans, and changes in immigration. So, you know, Fidelity has an estimate that $250 billion in tax from tariffs is going to affect the consumer. I actually think that's a pretty conservative investment when you estimate when you think about the actual effective tariff rate and the incoming imports that we have, right? So let's just say 250 billion. That's about half of potential GDP in any given year. You know, half of GDP. Let's estimate that potential GDP is around $500 billion. $250 billion is about a 50% drag on that. And then you add on the fact that student loans were paused from 2020 to 2024. You know, it's been a year since they've been turned back on, and we've seen people go from you know, zero defaults, obviously, because they didn't have to pay their loans, to back to the historical norm of you know, closer to 10%. Now, you know, I say back to the historical norm. You know, what's the big deal? That's the normal run rate. Well, the big deal is when people didn't have to pay their student loans, they were able to pay down debt elsewhere. They were able to improve their credit scores. That enabled them to buy cars and houses. We know that we had a big run up in the housing market, for example, and I think this is a big reason why. Now those borrowers, to the tune of 4 to 5 million people, are going to get hit on their credit scores about 150 points. So if you were, let's say you were a prime borrower at, you know, a credit score of 700, now you're subprime, you know, with a credit score closer to 600. That makes your credit availability lower, your spending power lower, your interest costs higher. I think we're seeing that if you look at a stock like CarMax right now. There's a clear problem with that company. Their CEO just resigned. Their stock's down about 50% year to date. And that's not the only company affected. You know, the housing industry is frozen right now, for example. There's no buyers, and the sellers are reluctant to lower the prices. And that's spurring conversations about, you know, 50-year mortgages and you know, things like that, which can be interesting to talk about. But it's hard to measure. You know, Fidelity has that $250 billion estimate for tariffs. It's even harder to measure with the effect of 4 to 5 million people having credit scores fall, you know, 100 to 150 points. Considering their student loans too, you consider this isn't the lowest income bracket, right? These are people that probably make a decent income relative to the average, since, you know, they do presumably have college degrees. And finally, immigration. We went from letting 2 million people into the country in 2024 to sending 2 million people out in 2025. So it's a 4 million person swing. If you estimate that these folks make about $30,000 a year, you know, you get about a significant dent in the potential effect drivers of the economy. It's in addition to that, it's inflationary. Wages will go up or services will go down. Either way, the economy is worse off. So when we talk about GDP, potential GDP, we talk about it in real terms. So if inflation were to go up, particularly in the service industries, we talked about construction, warehousing, retail, then you basically have a 1-for-1 drop in GDP because of that. If prices go up, you also typically, since there's elasticity in demand, you should expect demand to fall as well. So there are these drivers that are bringing the economy down. There are drivers that are bringing the economy up. There are certain risks that could make this better or worse either way, right? Tariffs were really, really bad in April. They're not as bad today. There have been carve-outs. There have been companies finding their ways around it. The administration has just lowered them generally, and it's been a a changing target, but generally speaking, without a doubt, the situation is much better today than it was in April.
Well, Brian, we do have something that's pending that could change. I don't think the immigration situation is going to change, but on tariffs, I think we have a big unknown. Is that's a case before the Supreme Court currently, and I think I'll say the majority of commentators on constitutional law, legal scholars are suggesting that it's a strong case that the president did not have the authority under the provisions of the law that he was using to enact the tariffs. And it's quite possible that that power and those tariffs could be stripped away. So I assume you think that would be a significant positive to the market and to the economy if that was to happen.
I do think it would be a significant positive, and I hope it happens. And I'm not a legal scholar. I would say, Jeff, you're the only person here with a law degree.
Mm-hmm.
I'd be curious on your opinion on this, but
well, I said in a previous show that I don't think the president has the authority to unilaterally institute a tax, and so that's the question that the court is going to fundamentally have to answer: is a tariff a tax?
Yeah.
And I think a tariff is a tax. So my guess, so you can look at this from a liberal or conservative point of view. I tend to lean towards the conservative side, and a conservative jurist or legal scholar, neither of which I claim to be, I am a lawyer, but would say that you're bound by the four corners of any document or the Constitution. And in Article 1 of the Constitution, tariffs, arguably taxes, are the purview of Congress. And if you're a liberal, you want to limit the presidential authority. So I think this is a case that could be a clear uniting of the Supreme Court, maybe not all 9, but not a 5-4 decision, that the president does not have the unilateral authority. Now, Congress could act after that and give him the authority. They could delegate their authority to him. But I think it's more likely than not that the tariff power is not constitutional.
Now, there's been talk that by the White House, they would just simply choose a different means of authority from a different type of authority that's been delegated to them previously. Is that possible, or would that undermine that from a Supreme Court decision?
I won't be surprised if they try it, but I think they're going to end up back at the same place. I think the safest thing to do, if the Congress is interested, if the Supreme Court says the tariff is a tax and then voids the tariffs, Congress can pass a tariff authority to the president, a limited, specific authority, which would give him the authority to do X, Y, or Z. I think that's the solution to the constitutional problem. But can Congress do anything? Well, they did reopen the government, but it took them 42 days to do basically nothing. So we'll see. We'll see. Brian, I also wanted your comments on, we talk a lot about specifics and, pros and cons, strengths and weaknesses of the economy and risk factors and encouraging factors like AI. What do you think about some of the old kind of just general ways to look at the market? For example, two phrases, two maxims keep coming to my head. One is don't fight the Fed. And the other one is the trend is your friend. So can you kind of talk about a larger kind of broader view of the market with these, not with these specific risks, but just kind of thinking about interest rates are likely to be lower. What type of impact does that have on a stock market? And do you buy that the trend is your friend? Do you think, it's like a physics question. something moving keeps moving.
Inertia.
Inertia, yeah.
Until it doesn't.
Until it doesn't. But I guess where we are today, do you think there's a trend? Do you think we're in this secular bull market that's still strong? And do you think that
trends tend to last until they don't?
I know.
Yeah. All right. Yeah. Sorry.
No, you get the point. Like, are we in just a favorable setting for this bull market to keep running?
So let's talk about why those sayings exist, right? Don't fight the Fed. You know, without getting too into the weeds of how you value stocks, but interest rates are an important aspect of that. And and let's differentiate between short-term interest rates and long-term interest rates. For the most part, the Federal Reserve only controls the front end of interest rates, which means if you borrow floating rate debt, for example, it does impact you, and a lot of debt is floating rate. Home equity loans are floating rate, construction loans typically are floating rate, credit card rates are, believe it or not, floating rate, albeit with a very, very high base. But a large part of the economy is fixed rate and won't be impacted at all, really. So, for example, I have a fixed rate home loan mortgage, and I'm sure a lot of people do. In fact, I know that the vast majority of homeowners have fixed rate mortgages, so they'll largely be unaffected there, right? Now, when we talk about stocks, we typically are more concerned about the 10-year interest rate because stocks are long-term assets, so we need to compare it to a long-term interest rate. Now, if the 10-year, I think the broad assumption by the public is that it will go down if Fed funds comes down. That's not necessarily true. If the market perceives that bringing down the Fed funds is a mistake, for example, and will lead to higher inflation in the future, then the 10-year rate will actually go up. So if you are basing your investment criteria on lower interest rates, I would just encourage you to rethink that because it is possible that lower Fed funds rate will lower the 10-year, but it's not guaranteed. My expectation is what we're going to have something called a bull steepener, which means the front end of the curve will come down much faster than the longer end of the curve, and we can talk about the investment implications of that. But basically, what I think is going to benefit is regional banks more than anything, and that's been part of our investment allocation for that reason. But that's why that exists, right? The idea is that the Fed funds coming down will lower the 10-year Treasury. All things equal, if the 10-year Treasury comes down, stocks become more attractive versus the risk-free asset. So there is a fundamental reason why that saying exists, and I think unless the Fed is making a mistake, which is also debatable, right? That I think that's a good general rule of thumb. The other one that you mentioned is the trend is your friend. I think this happens because the economy tends to build on itself. When let's talk about the fractional banking system, for example, right? If Jeff, if you put $100 into the bank will lend $90 of it to someone else. That person will put that $90 in the bank, and that $90 will be lent out to somebody else for $89, and so on and so forth until there's about that $100 becomes about $1,000 in the economy. As long as people are making money and then depositing in the banks, and they can continue to extend credit, and bank balance sheets can rise, the economy has this secular momentum to it, where it will continue to grow, right? And that's just one example, right? If another example would be if a company is building something productive, like AI, for example, and it enables people to become more productive and produce more goods and sell more goods, and reinvest that into a new project, well, that can build on itself. So I think that's why the economy tends to grow into secular bull markets. I think the trend is your friend in that sense. Now, I think what Chris is saying was spot on, though. Like, trend is your friend until it isn't. So you need to look at things and you need to be constantly aware of these things that could derail the trend. For the most part, I think it's the extension of credit. So if I started with that bank example on purpose because it was about as long as banks are able to to lend and borrow and increase deposits, well, you kind of have this secular nature to the capital market system. And if that halts and it doesn't continue and it doesn't continue to grow, well, then, you have a problem. And that's basically what happened in the financial crisis, right? That's, partly what happened during the savings and loan crisis. It's partly what happened in, the 1998 long-term capital management crisis. So to me, 3 out of the last 4 recessions have been caused by 3 of the last 5 recessions have been caused by the changes in the extension of credit. So, yeah, I think that's true. I think I look for change in trends. One data point does nothing to change my psyche, but one of the trends that we've seen over the last few months has been a change in inflation. We had a downward sloping trend. It's like a mountain, right? Inflation went way up and then it started coming down. And that trend was nice. We were at 3% and it looked like we were trending down to 2%. And now it's starting to tick up again. So that's a trend that's reversed. It was our friend until it wasn't, to Chris's point. And that has implications, right? It has implications on the yield curve, like I mentioned before, and the yield curve has implications on stocks.
Chris,
it's all related.
Bring this down to a personal financial planning question for you. Over the past few years, with money market rates and CD rates above 4% at some levels, I know they're not there now, but they were. Many clients and investors were comfortable, like keeping money on the sidelines if they could lock in 4.5 or whatever that number is individual.
4 and 5%. Yeah.
Do you expect that if rates, short-term rates, money market rates, for example, savings rates, continue to trend downward, that some of these people will say that's not high enough for me, and maybe be asking you, like,
we have seen
where
that
can I put this money?
Conversation increase, Jeff. Yeah, to your point, I think you're absolutely right. It's a fine line to determine what's an appropriate amount of reserve, what's an appropriate amount of cash to retain. On the one hand, we want liquidity, we want a resource for stability in the mix. We do think in terms of this buckets approach to the way we approach financial planning, and the idea that it's important to have some variation. Long-term money should be invested, but it will be volatile, and we want to stay the course. We want to have resources for where we can draw from when that happens. We want resources for the unforeseen, not have to use credit card, debt, as an example. So having the right amount of reserves is really important, and often overlooked, and particularly coming out of the last decade or whatever it's been, where we had very low interest rates, people were less inclined to carry a fair amount of cash. This last year or two, or a couple of years, where we've had higher short-term rates with the money market funds, it's been particularly appealing for people to say, okay, it's a marginal difference in what I expect from my longer term number by the cash. So I'm less I'm more reluctant to give it up, and I feel less compelled to have as much invested. Today, I think you're right. People are starting to revisit where they might have been accumulating excess cash, maybe more than they really needed for their reserves, but felt a certain comfort in that. Maybe now they're revisiting, well, do I have too much?
Right.
And, I do think that's a challenging thing to navigate. We have some rules of thumb that we use when thinking about this in the context of the financial planning and looking at what you're spending and the net spend, how much after your income or whatever you're in retirement or in pre-retirement. These are somewhat different equations, but we definitely have some guidance we can offer people in that process. I know we're late on time, so we won't get to go through everything we might have wanted to talk about when thinking about this conversation with Brian. But Brian, I will mention for our listeners who may be interested in watching our webinar, and get the full benefit of that. In the course of that webinar, Brian talks about some of the things that our team in our discretionary managed portfolios are doing in the strategy that ultimately that Brian is at the heart of the decision making of how do we navigate this K-shaped economy? How do we embrace artificial intelligence as an opportunity while at the same time not going off the deep end with risk? How do we manage risk in both the tradition of asset allocation, what we invest in for asset class selection and where we fit relative to our target allocation, and then some alternative investment offerings to say, will these help us to have ballast for when volatility inevitably does enter the market at some point? May not be right away, but at some point there will be volatility. So how are we positioning in case it's sooner than later, while we want to be opportunistic and participate in market opportunities? How do we manage risk? What are we doing? And these can be things you can find out by going to our podcast, as you said, Jeff, our webinar rather. You'll include the link. Brian did a great job elaborating on this in our recent webinar, and give you some food for thought. If you're someone who is in the midst of trying to navigate these challenges as an individual investor, maybe you're doing this with someone, but you feel like it's perpetually driven by your prompting, not proactive consideration, or you're questioning whether or not you're getting the kind of management and performance and risk management that you'd like. These are all instances where we find people are taking interest in talking to our team to get an assessment of a second opinion. What do you think of what I'm doing? How's it going? Should I do something different? When it comes to this process, we like to put everything into the context of the financial plan, because in that cash reserve liquidity discussion fits into that. Other strategies about tax planning and tax management, with strategies about, when should I do a Roth conversion or not? All of these variables enter into the kinds of conversations we have. Portfolio is it's really a central part of one's financial security, but it's not the only consideration. So we try to look at a broad context of all that's involved. And if you would benefit from a second opinion, take advantage of our complimentary consultation. We meet with you. It's really a two-step process, and would be happy to have you take advantage of it. Any last comments, gentlemen, before I sign off for us? Brian, anything that you wanted to get in that we didn't get to?
Well, there's a lot that we could discuss about, how we are allocating. But I think you did a good job pointing people to the webinar if they have a lot of interest. But I just remind people the market goes up 80% of the time. It's good to have look for the positives rather than the negatives, and look for real fundamental changes where, as Jeff would put it, the trend is your friend until it isn't, right? So look for those things that'll cause the real secular trend to switch.
Good comments. Jeff, anything else?
No, thank you, Brian. We appreciate your expertise.
Great job today. Thank you, gentlemen. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.